All right. It's Jared here from Crypto Plan. How's everyone going? We're getting smooth today. We're going to learn something new. We're going to learn a trading strategy, make some rules. Hope you like the new track. Yeah, that's a smooth one. Once again, the Noxiv and Clive free music, link in the description if you like free stuff and using it in music, videos, production, whatever you like. I love the way the world is all about sharing stuff at the moment and royalty free. It's great. All right, so that's enough of that. We are here to talk about trading strategies. I am learning new things and I want to share them with you. Once again, free stuff to you. I have read a really great book, or I'm reading a really great book now. Stan Weinstein's How to Make Money in Stock Markets, or whatever it is. Hopefully I'll link it in the description. But if you've been trading for a while, you've probably heard of it. But I guess now I've read it and I just want to share it with you. And I just want to share, I guess, the take on it, using the One Harmony chart, looking backwards and seeing if his strategy would have worked or how it would have played out. So once again, we've talked about this before. We need a weekly chart. We need a 30-week moving average, or a 30 MA. I've got two indicators on this chart. I've got a normal relative strength index and I've got a Mansfield relative strength index. So that's comparing it against the S&P 500, I believe. So it's just saying how well is it doing compared to the market. And that's very important. And then we've also got volume along the bottom and the side. So we've got volume defined by price action, the amount of volume at a price action. We've got volume in general for the week. So we're going to combine all of those things to decide when we would enter the stock according to Stan Weinstein's rules, and maybe kind of tweak those rules a bit ourselves. And just look at how you'd play it depending on what sort of investor you are. Because, if you're just trading, then there's a different approach to if you are investing, if you like. So we're going to look at both ways and you can decide which one you are. And hopefully it helps you make money in the future, because you can apply this to any chart at all. And I guess one thing to remember is that this strategy works best when you're participating in assets that are, the entire asset class is in a bull market, So if you were doing this on a crypto chart during the bear market, it may have less percentage gain success than it would in a bull market, for example. Or, if you're playing gold or silver mining stock, now compared to in maybe 10 years when it's in a downtrend, you would get different results. So just be looking at the market indexes as well to see if they're also in a uptrend or they're in a stage 2. So we are looking for stocks, or we're looking for assets that are moving into stage 2. So we'll just walk through it again. This Harmony 1 chart has pretty much all of the stages in it. So we're just going to get our pen out and just draw things out. So this is our stage 4 downtrend, where we were declining rapidly. So if you bought in here, you probably bought on some good fundamentals, but because the thing was in a bear market, it declined fairly rapidly. Now, it also then kind of found a base, you know what I mean? So this base, even though there was the March dip, you can see that this base kind of held true for quite a while. So that's our stage 1 accumulation. So it faked out of there, pulled back down, but we could see that, in hindsight, that this is a base. And once again, based on the market, the entire crypto market was in a basing stage 1. And then we've got stage 2, which is the area that we're looking to trade, right? So stage 2 is the parabolic uptrend, or, the really fast moving price action. And then, we're still in a bull market, so this is yet to play out. So there's these ideas that you've got to remember, and this is where it changes your strategy, whether you're a trader or an investor, because there is potentially, this short-term bear market, so a short-term topping which is a stage 3, a pull down, which is a stage 4, and then we will go into a stage 1 accumulation again within a bull run, so a shorter term kind of 4-stage move, and then we'll move out, most likely into a second leg of stage 2. But you could also just call this a correction within a stage 2 bull market, because it hasn't gone below its 30-day moving average. But we'll kind of address that in a wee while. But yeah, essentially what will happen is that some point in the future, we will top out, and let's just say our $1.20 range. Some point in the future, later in the year, we'll top out and we'll kind of see those 2 or 3 spikes, a run up in price, a final price discovery, then a retracement rally, and then we'll go into a bear market, right? And it will rinse and repeat in 4 or 6 year cycles, depending on how crypto goes in the future. All right, so we're going to delete all of that stuff. So now we want to kind of have a look at the trading plan, right? So Stan Weinstein would say that you never buy a stock or an asset below a 30-day moving average. So he's trying to say that, you could have bought it down here on the March dip, but you have a long time to wait. Sometimes you can get bored and get shaken out, right? So he's talking about trying to make the entries at the right time when things move, so that would have been somewhere around here, right? But this is hindsight data, and you can say, oh yeah, that was a good time to buy, but how would you have known that's a good time to buy, right? So you would have had this, at this point, the 30-day moving average was moving along and price was trying to break through it. So that's kind of a look and see and watch, that's a look and see and watch. And we can see that, the 30-day moving average is inclining. So that's what we want. We want it to break above an inclining 30-day moving average. Because even if it breaks out above a declining 30-day moving average, it can still be a bit tricky. We know that, we're in a bull market at this stage because Bitcoin has broken out, maybe Ethereum's broken out. So we know that we're close, and there's going to be an attempt for this to break out in the future, but we just want to know when. So we're touching. Scary moment. So once again, good reason not to buy here, because we'd see this dip. And then, it was really this first week of January where we broke out officially. So we would see this breakout, and now you would be justified to make an entry somewhere in that week, on that breakout, because you're seeing the 30-day moving average, you've seen it test, and then finally it breaks out. Been in a long stage 1, so there's every right for an accumulation to happen. Things around you're seeing them pop out, so every right to make a third of your entry, a half of your entry, depending on your trading plan at this particular point, right? Now, the reason why you don't put everything in is because there's every chance that it goes up like it does, and then it kind of back tests. And that's exactly what it did do. It went up, and then it kind of came back down again and closed that next week above the line. So that was kind of our confirmation. So then you might go, well, I'll put the rest of my position in here. So we've confirmed that we've had a breakout, and then the rest is history. You can see what happened. Now, so you've got your full position in there. What do we do? Oh, sorry. And the last thing that we were looking at, really, and by Stan's rules would be, and he probably maybe would have passed this over on a technical rule, is that this particular volume was declining. It wasn't increasing. It was probably more this week. This 25th of January, where he possibly would have entered, where volume went above average, and then the week after when it really went above average, right? So that could technically be a better trading entry, because your money would have moved faster and harder to the upside, right? And then even still, on this kind of breakout, because at this point there was still some chart resistance, that it went up, pulled back, and then once it had cleared that small correction, there was no chart resistance. And you can see that's why there was those 3 massive weeks, 50%, 100%, 115%, and then on the monthly chart, I think it was like 600 or 700% on the month. So, you could have held off if you were just a true trader trying to take quick chunks out of the money. You could have entered after this pullback, or even on this pullback, and then ridden that all the way to the top. So yeah, once again, you need to define what sort of trader you are, and you can be both. You can make your long-term investment position here, for the entire bull market, and then you can make your trading position. You might want to put 10% of your entire position into this trade just to make cash flow for the month, kind of thing. So you can invest in both ways at the same time. You just need to have a strict plan. So that's that. We've entered our position. Now what would Stan Weinstein direct us to do? The last thing, sorry, I forgot, was down on this relative strength index compared to the market or the S&P. Confirmation here was, at the time it was breaking out in those couple of weeks where it was just breaking out and kind of hovering below and above the 30-week moving average. It went into positive strength, so it went above the zero line. So that was another good indicator. And once again, when it kind of kicked up here, that was the real confirmation to kind of enter the trade. So, anywhere in the month of January would have been a good time to enter, and you would have just set a price level based on your own chart analysis. Maybe it was this wick level, once it breaks over the 0.07 cents, I'm going to make an entry. And that's what he would suggest. Set a limit price or a stop order above, a current price, and go, I want to enter then. When it goes up to that price and breaks through, you might have a stop loss here just in case it went against you. But then, you would hold that position. So trading rules now. So you're in the trade, whether it's a long-term trade or a short-term trade, you still want to secure gains, right? So, you might go, well, okay, we've cleared this resistance level here. I'll set a stop loss at 1.4 cents. So that was good. We jumped above there, and so you'd set a stop loss. So you're locked in at least, maybe slightly below that resistance level. Here, so that you set in, at least some profit. You might set half of your position to have a stop loss there, right? And then it goes up and kind of corrects again, and then you can see this dip here. So now you might readjust that stop loss to 0.016. 1.6 cents, right? And then it kind of runs up, and then you'd be kind of following it all the way up and setting your stop losses, right? And then by this time, there's a chance that, one, you're choosing to take profits because you're seeing that it is kind of topping and it's getting quite extended from that moving average. So you could make a decision to take some profits at that point, once it was getting up. One way he would suggest of doing this, and I agree with this way, is that, if you were to draw a trend line, say from this wick here, you noticed it kind of touched there. So when it kind of touched that trend line again, it reacted to that and bounced off and went sideways after that. So you could potentially use an upper trend line of like, when it taps that or when it gets near that, I'm going to take X percentage of profit out of the market, so I'll take 20% of my position off the table or 40% or whatever. If you're a pure trader, you might go, I'm going to completely close my position and just take my profits and move on to something else while this thing is correcting, right? Because as you get on, you're probably going to realize, and I'm just learning this, that large extensions from moving averages always end up in corrections. Whether they're longer term or short term corrections, they always kind of end up in corrections. And this one, you can see, didn't go below the 30 moving average, so there was another good entry point here. So are you ask yourself, is it a long-term position? Am I holding it for the whole bull run? At this point, you're going, I'm holding, I don't want to sell any, I don't need any profits to take. Then you're riding this correction out going, it doesn't bother me because I'm still in profit. I've got a stop loss down here just in case things go pear-shaped. A stop loss somewhere here just in case things go pear-shaped. It pulls back to the 30-week moving average. Yay, I've got a little bit more money that I've saved up. I'm going to enter some more into my position. So this is the idea that, to switch your psychology. Are you a trader that used to or does still, dollar cost average down? And I know that it's a bad habit of mine, is kind of, trying to catch a falling knife. Now, I don't do it with large sums of money, but sometimes you kind of dollar cost average down, especially when you're in the bear market. You're just trying to build an initial position, but sometimes it's better to average up, right? Because the price is moving, average up, and then, you're selling into rallies and you're selling into profits in the end there. And you're always above your your position. Whereas when you're averaging down, you're kind of like going, well, I bought something, it went down by 50%, I bought it again. Now I'm, only 25% down, but I still need to get back up to sell out. Whereas when you're averaging up, you're always up. If you're buying at the right times on the way up, if you're not buying at the top extensions, if you're buying on the corrections, you're in a good position to be selling out, right? So that's kind of the strategy there. And once again, if you're a pure trader, you might have kind of bought in here, added to your position somewhere again there, maybe added a bit more here, sold out completely here. And then sat on the sidelines, played something else, and then bought in again here, waiting for the next move. Or even better still, you might just wait entirely till it breaks out again of this range, and then do the same thing all over again. Because this might go on for a while, and you want to keep money moving quickly, so you might actually wait for a breakout above, 20 cents or something to actually start trading again in this particular asset. So that's the 30-day moving average strategy. What have we looked at? We've looked at above average volume on the weekly chart. We've looked at the Mansfield Relative Strength Index going above zero at the same time. And there's this green zone here. You'll need TradingView for these kind of features, and you'll need a paid subscription, I imagine, especially for the volume kind of indicator on the side here. Once again, these volume indicators can kind of be good points to set stop losses, maybe slightly above or slightly below, depending on how you want to play it. And then, we've got a 30-day simple moving average, or 30-week simple moving average, or a 30 period moving average. And that's kind of what we need to do this trading strategy. And the other thing is, remember that this One Harmony asset at the time is in a bull market. Bitcoin's the leader of the market, or it's the the index of the market, and that was in a bull market, so it was a positive environment for assets like this to move aggressively to the upside. So that is that. I hope you have got some good value out of that, because that's what I'm all about, is sharing good value for free. And please go out and listen. I listened to the Stan Weinstein book as an audio book, and it comes with a PDF, and he explains this in many charts, and obviously in a lot greater detail than I have here, because I don't want to make this video too long. But that's, in hindsight, it's a strategy that I'm probably going to look to employ in the future, at least for, a percentage of my portfolio that I'm looking to trade for cash flow. I think I still will accumulate on large dips in bear markets, because, that's more about long-term investing, and, building up assets that you're going to hold for longer periods of time. This strategy is more like anywhere from a couple of weeks to 4 to 6 month kind of trades, maybe up to a year to 18 months, depending, in the kind of commodities bull run coming up, you might be looking at holding, for several years, but during that you might be scaling out and scaling back in based on corrections and pullbacks, if you know what I mean. So you've always got a base position there, but you're taking profits along the way, then you're adding on weakness. It's up to yourselves how you kind of refine that strategy. But there it is. There it is for you to kind of have something new to think about, and potentially use that to make more money in the future. And that's what it's all about. It's all about kind of having your money moving, and not kind of buying in stage 4 or stage 1 and having this kind of like when's it going to break out, having this moment where it breaks out, then it pulls back again, and you're always looking at this portfolio that is whipsawing and zigzagging and seesawing. Wouldn't it be nice to just always enter in this position and just watch it go up, and then sell out? And you're psychologically, you're always in the game, because you're making wins all the time, and the opportunity cost of your dollars are not being wasted here, because while you're in these 2-year bear markets accumulating great low positions that on a percentage level will give you great returns in the long term, there is an opportunity cost where you could have been multiplying those dollars in other bull markets, which were in stage 2, then putting it in here, and then riding that wave out, taking this money and putting it into another stage 2 and riding it out, and then you're continually aggressively multiplying, right? So these are the ideas that we want to make a reality, right? Is like have that money growing and growing and growing, and it's the 30% a year on year increasing of your portfolio that will make you very, very wealthy, and that's my plan. Not to be wealthy as in stinking rich, just to be always ahead of the game, always be able to choose when you want to invest money in a business, or when you want to invest some money in a new car or an idea, or give some money for your kids for a holiday, or whatever it is. You just kind of always want to be ahead of the game, and not kind of going, well, yeah, it'll come true and I'll be able to get this in 4 years when my really deep, low bottom entry on a particular chart comes fruitful, and that's great. And it can be like a lottery, but it can be a long and impatient time. I've been Jared. This has been Crypto Plan. I hope you've liked these educational videos. I know I do, and I know I would, and this is why I'd make this content. So please like it if you do, and subscribe to the channel and click the notification bell as well. Bye for now.